Hi, everybody. This is Tim from TradingStrategyGuides.com. It's morning here in North Texas, and it's going to be a hot one today. Not as hot as it could be. But in any case, good morning. Make sure you got some coffee on your desk. Coffee is an important part of your morning. Today, we're going to look at a very simple and straightforward trading strategy based solely on moving averages. But first, I want to make sure you guys can hear me and see my title slide. Can you hear me? Let me know. While I'm waiting for some responses, if you're watching this recording live, then you get to ask questions. But if not, you can speed it up by clicking the gear icon in the lower right and selecting a faster speed. So that's our trade-off this morning. Thanks, Romano. Thanks, Nina. Thanks, Ed. Appreciate it. Stay around to the end, and we'll be reaching into the archives, way down in the archives. Thanks, everybody. I have trouble with my mic cable, like all the time when I'm recording videos, so I'm always a little apprehensive about the sound for our webinar. Anyway, we're going to reach way down in the archives for a trading maxim this morning. Actually, way down in my life. But we'll talk about that in a little bit. Don't forget to click the subscribe button and then click that bell for notifications. That way you'll know when a new video is coming out. Let's look at a few of our open trades. Plus, I forgot. I've got a bonus trade for you guys this morning too. I keep finding these things and I don't want to wait until Friday, because sometimes I have a feeling these things may break out before Friday. So anyway, let's look at the formerly open trades. Kraft Heinz, I closed this thing. I mentioned Monday that I was going to close this thing on Monday's close, and I did. So I exited it for minus 19 cents, which is, I don't know, I think it was about a 0.5% loss on this. I'm going to watch it. It seems to be making this continuation triangle, but they can break in either direction, and I was just tired of this sideways. The whole point of these trades that I take are, we've got this nice consolidation here. I forgot you guys can't see this cursor real well. We've got this nice consolidation right in here with a decline in the volume and a decline in the volatility, which means traders are getting bored and they're waiting for it to do something. And then finally it does something actually right here, and it did it on volume more than average volume. And so we jump in it there. So the idea here is, at this point, we should have momentum that should carry us at least up to 1 ATR right there. In this case, it didn't. It started just going sideways and even getting a tightening consolidation. And a tightening consolidation, once again, could break in either direction. So I would rather just get out of this for a small loss and then see what the consolidation does. So that's where I am here. That's where I was kind of on Cavco here too. So this closed back in the range. First of all, the range was down here at 162 and change. And I took it on this, but I was not comfortable because it didn't close higher than this candle over here. I keep forgetting again. I entered it on this candle right here, but I was uncomfortable because the close was not above this candle here. And I probably should have drawn this line above this close to begin with, but I didn't. So I was in it right here, and then it closed back inside yesterday, day before yesterday, Monday. And so I mentioned again in Monday's video that I was going to exit if it did not close outside of the triangle, and it didn't. So I'm out at 161.39. And then news on Monday night, which, again, I should have been paying attention, and I totally missed it. They had a really good earnings statement. They got 231, but it was estimated at 195. And of course, the surprise is what moves the market, because the estimate is already built into the market. And it's like I've said lots of times, I firmly believe that everything you can know about a stock at this moment is already built into the chart. And so $1.95 was built into the chart, but this 36-cent surprise is what drove this out yesterday on huge volume. When I say huge volume, I mean the average is like 75K, and it drove up for 240K. So that was a really big explosion. So I bought it at 176, and the target is 182.40, and the stop is 166.40. So the ATR was $6.40 on this one. So that's where we're at. Market's not open yet, so we'll see what it does today. Okay, EURCAD. Wow. Okay, looks like we might be getting this breakout today. What was it I was going to talk about here? The descending triangle that we're looking at was getting close to the end. This is typically toward the end of where I would expect a triangle to break out, somewhere near the point. So it looks like we might be getting this breakout today. So watch today's close. If it's down here and we have at least 75% of the volume, I'll be selling this one. Okay. Check below for a link to the trade management video that'll explain how I do all these things. But in this case, if it makes average volume, I'll go in full size sale. If it makes at least 75% of the average volume, I'll go in half size. And I'll talk more about that in just a minute. Okay, one more. Renault. Now, Renault has opened anew. This is a European stock. But yesterday's close was below the continuation triangle with sufficient volume. So I sold this one. You could get a better price if you get in this right now. So this is pretty good. Selling this one, the target is 49.37. So let me put that down here. 49.37. And the stop loss is 53.10. 53.10. So that's Renault, RNO at Euronext Paris. Okay, and here's the trade setup, the new setup. Crude oil. I love consolidations on crude oil because they always explode big, especially one that's been consolidating for this long. So it goes back here to April, and particularly, right in here is when it started to actually establish this triangle. Volume has been dropping off. Volatility hasn't been dropping off quite as much until the last few weeks. But this is a continuation triangle, and I would expect this to break in the direction of the initial trend, but it could break in either direction. So we're going to either buy a daily close below it, or we will sell. And let me try that again. We will buy a daily close above the triangle, or we'll sell a daily close below the triangle. So candle close outside of the triangle, that's your trade direction. Okay. Want to see at least average volume on the breaking candle. So when this breaks, I want to see this volume bar reach up to the average line right here. Okay. To go full size. To go half size, I want it to be at least 75%. And that's a simple calculation. Take the volume here, divide it by the average volume here, and you should get at least 0.75 on your calculator, and that represents 75%. So if you have at least 0.75, then you can go half size. Okay. The stop loss will be 1.5 times the ATR. So on the breaking candle, look at your ATR right here, or average true range, which is the average length of the last 14 candles. Multiply that by 1.5, and you add it. If you're going short, if you're selling it, you will add it to get the stop up here. If you're going long, you will subtract it from your entry to get your stop right in here. The target will be 1 times that same ATR, so that would be, of course, below a sell or above a buy. Okay. Now, if after entering the trade, the candle closes back inside the triangle, take the loss right then. Just go ahead and close it. Don't wait for it to hit the stop loss. I mentioned this earlier. I'll shut down trades early if they're not working as intended. And like I said, the intention is the breakout from these patterns should be explosive, and they should hit the first target fairly quickly. If the momentum goes away, just want to get out and see what the price is going to do after that. Now, this sort of thing is going to happen once in a while, but this is unusual. Okay. Situation where I got out. If I had stayed in, I would have hit the target. The target wasn't quite as high, but I would have hit the target and so on. But, it could just as easily have gone this way, especially since it was back in the consolidation. Okay. So that's the reason why we just get out of these things as soon as they close back in the consolidation area. Okay. When the price hits our first target, we'll close half the position for profit, set the stop loss to break even on the remainder. And we'll just follow stops as the price moves in our direction until the market takes us out. Now, obviously, you're all grown up, and I'm not your mama. You can do what you want to. All right. I'm just telling you how I do these trades. All right. So if you want more details about that, like I mentioned, the trade management video will be linked below this video. If it's not there as soon as the video appears after this webinar, then check it out in a couple hours. I'll get it down there as quickly as possible. Okay. Does anybody have any questions about that? Mark, will the USD go down? To be quite honest with you, I haven't really looked at the USD. Let me see if I can figure out how to look at that. I don't think I have the... I've heard all kinds of talk in the news and stuff about this and that, but the truth is I just look at the chart, and And obviously anything I say will be just, based on my technical analysis expertise. And I, granted, I am pretty good at it, but let's see, U.S. dollar index, DXY. I couldn't remember that to save my life. Well, it's obviously banging on a level up here, and this is definitely a reversal type candle, but one candle doesn't tell the story. Um, so yeah, I mean it could. Um, I don't see any particular um, indications that it's going to go one way or another, except for that candle and the fact that it's slamming into a resistance level right now. But it could just as easily just break through the resistance level too. So I would have to analyze this a little bit more to see if there was any other signal. Well, here is one thing. This is 4 slams into this resistance level, plus this push up right here, which kind of forms a ascending triangle. And ascending triangles typically, let me move this down where we can look at it. Ascending triangles typically break to the upside. So this pattern right here kind of suggests to me that we might be looking at more upside here, but this is not a really huge consolidation. One of the reasons why I don't like looking at the US dollar index is because I don't have volume to go along with it. But the volatility is dropping off, so anyway, this could go either way, actually. Lawrence, I prefer daily charts. But that's just me. Okay, that's a personal thing. And the reason is because sorry, I had to get a swallow of coffee. The reason is because I have focus issues. Ever since I was a little kid, I thought it would be cool to be a multitasker, which is not really multitasking. You're not doing a whole bunch of things at once. You're just shifting your focus from one thing to another and losing time every time you shift your focus. So multitasking, in my opinion, is not even a thing. But that aside, I trained myself ever since I was a kid that when things were slow at whatever it was I was doing, I could shift my focus to something else and accomplish something else while I was waiting for that thing to start doing something. Well, that's been detrimental in my programming. In my trading, it's been very detrimental. And the reason is because you have to stare at the charts when they're not doing something. If you trade 1 minute charts or 5 minute charts, you've got to continually stare at those charts. Otherwise, you're going to miss whatever event you're waiting for. So if the chart is going sideways or it's not moving very much, all of a sudden my focus moves on to cat videos, or I just kid about cat videos, but I mean, I do enjoy them sometimes. But I might be looking at my email or reading some article that I had set aside to read or something. And then all of a sudden, I look over at the chart and bam, I've already missed whatever event I was waiting for. Now, I allow for that by setting price alerts and that kind of thing, but still, I don't like doing that. So I trade daily charts because I don't want to look at the charts 24/7. I mean, I'll stare at charts, but I don't want to stare at a specific chart that's not doing anything. I will just go through, pour over charts and look for patterns and that sort of thing. I can do that. But when it comes to um, when it comes to watching for events to happen on short-term charts, that just doesn't work for me. So you see, it's a really personal reason why I trade daily charts, plus the fact that if I want to take a day off, I can. I've just got to sit down before the day closes. And there are several different day closes depending on what I'm trading. But all I do is I just set an alarm to remind myself to go look at the charts, because the cryptos close at 7 p.m. and that's Central Time, I think. And the um, Forex closes at 4 o'clock my time, and so on. So I just set alarms that remind me that those events are happening, so I can go look at whatever charts I need to look at, and um, it just makes my life a lot simpler. Um, so there you go. That's my answer to that question. Yeah, Mark, I used to follow the dollar index religiously. Actually, there's an index for just about all the major currencies. And if you can, in trading view, you can just type in like Australian dollar index and euro index and all that sort of things, and you can uh, find the symbol for that. And that's cool because what they do, as far as I know, they take all the US pairs and do some kind of mathematical magic on them to come up with the dollar index. And what I used to do was I track the dollar index and look for patterns and such on it, and then find a US dollar or just trade a basket of US dollar pairs. So, Ed, Head and Shoulders on this one. Yeah, yeah, I see what you're saying, particularly if you look at one of these as the left shoulder and one of these as the right shoulder, and this as the head. On the shorter, I mean, on the longer term, like weekly or monthly chart, that probably is a really nice looking Head and Shoulders. So, but Head and Shoulders should actually be reversing um, from the right shoulder. So I don't know. This little pattern right here is kind of bearish because wicks. Anytime you get wicks, that's price rejection. So price has been rejected several times from up here. So that's kind of a bearish pattern right there. But also, when you get this many attacks at a level, um, that's going to be eroding any sell orders that are in this area. Every time it attacks, it probably reduces the sell orders in that area, so it pushes further and further up through that line. So the bottom line is nobody can know exactly what's going to happen. So all we do is we lean on our experience, and we say, okay, this is what we think is going to happen, and we're willing to take a chance on that. But that's why you manage your risk. It's just like gambling, except that I think you can predict your edges a lot better in the market than you can in Las Vegas. But as long as you manage your risk, you can be successful at it. So, inverse Head and Shoulders in the triangle. Oh, yeah. Yeah, absolutely. I see that for sure. I don't usually trade Head and Shoulders patterns, so I don't really pay attention to them that much. But left shoulder, head, right shoulder, um, neckline, and break of the neckline right here. But typically, they say a Head and Shoulders, uh, it should uh, be, you should target something similar to the height of the Head and Shoulders. So this is what 146. So 146 up from here would be right in here around 98, 88. Plus, to see these patterns, not all patterns, but in this particular case, Head and Shoulders should have a stronger trend into it. So, because Head and Shoulders patterns, 1, 2, 3 reversals, that sort of thing, all kind of happen inside of consolidations all the time. So, Roy, I look at gold like every single day, and I don't have anything on gold right now. Um, well, it's down here on this watch list. Gold. Yeah, I have some wimpy, I had this wimpy pattern on here. And I took it, I bought it right here. It hit my first stop and then dropped down and hit my, uh, stop loss on my second half. So I got first target and then stopped out on the second half. That was, a couple of weeks ago. But this pattern was kind of, I like bigger patterns than this, and it did not give me the um, volatility drop that I would also like to see on these patterns. But anyway, right now I don't see anything. We could be getting something right here. I'll take a look at that, and I'll do a video Friday if I find that something really really good. Lawrence, do I trade exotic currency pairs? I guess it depends on your definition of exotics. Um, but I'm assuming you mean everything other than the 8 majors. Um, Once in a while, but usually not. Um, Once in a while, I've been known to do the Mexican peso, um, the Swedish krone, um, but usually not. In fact, I don't even look at them regularly. This is my list of the Forex pairs I trade, and these are all just combinations of the majors. You see, I do have Mexican peso down here, but it doesn't, I like trading daily patterns, and it doesn't pattern very well. So, other than that, I just stick to the 8 majors and all the combinations of 8 majors. Okay. Any other questions right now? Okay. Let's look at the big 3 trading strategy. This can be traded on any time frame in any market, including stocks, forex futures, cryptos, whatever, what have you. Since it works well on any time frame, you can use it for swing trading, uh, day trading, scalping. Why is it called the Big Three? Well, according to the Trading Strategy Guides blog writer, it's because it has 3 rules. But I'm just not picking up what he's laying down. With apologies to whomever wrote the blog, I'm not sure who did. But I like to think it's called the Big Three because it uses 3 of the most popular indicators. But what do I know? I guess the name is whatever it is because the strategy developer gets to name it, right? I mean, why does somebody name their kid like Aloysius or something? Apologies to anyone who has a kid named Aloysius. Um, I mean, because that's what they named him, right? It's as simple as that. Anyway, I digress. The strategy uses 3 simple moving averages: the 20 period moving average, the 40 period moving average, and the 80 period moving average. And of course, the moving average is the most popular indicator in the history of indicators ever. The actual moving averages you use will probably not make a huge difference in this strategy, except that the longer time periods you use, the fewer trades you'll enter. But you'll likely yield a higher win rate. So there are trade-offs there. Just experiment with different moving averages as you backtest the strategy. Okay. Now, for the purposes of these examples, I'll be using 20, 40, and 80 simple moving averages, and we'll be looking at all different time frames of charts just so that we can find the signal that we're trying to show you. Okay. Sometimes demonstrating these strategies, it's kind of tough to find a good example to show you or a clear example to show you. So these have been pulled from all different charts. These were done by the blog writer, and they date back a couple of years in some cases. So step one, determine the current trend direction on a higher time frame. So if you're pick a time frame that you want to trade, say the 15-minute time frame, jump up one or two time frames to say the 60-minute, and determine what the higher time frame trend is. And you do that by saying price is above all three moving averages, so therefore we're in an uptrend. Or price is below all three moving averages, so we're in a downtrend. Or, this is my favorite, you've got spaghetti because everything is intertwined and you can't tell what's up and what's down, and the price is right in the middle of that mess. In other words, the market is going sideways, it's consolidating, it's doing something, and you just want to stay away from this particular pair on this time frame until it gets its act together and starts trending. Okay, so I would just start at the beginning of the day, beginning of your trading day, and just look at all your charts. Look at all your charts on a time frame one or two above the one that you're going to trade, and just write down what your directions are for each pair, and then just stick to that direction all day long. So if you're going to trade 15-minute charts and go through all the hourly charts and say, well, the Euro USD is in an uptrend right now, so that's what we're going to trade. The pound USD is in an uptrend. We're going to trade longs only, and so on and so forth. Okay. Once you've done that, then jump down to your regular time frame on all your charts and go on to step two. Step two is you wait for an entire candle to close outside of the moving averages in the proper direction that coincides with the higher time frame. So let's say we're looking, this happens to be the Euro GBP, Euro pound. And let's say that you've looked at the 60-minute chart and it is in a downtrend today. So now you're on your 15-minute chart. So you're looking for shorts on this. If price is not below the moving averages or not headed to below the moving averages, then you know that you're not ready to trade this yet on the 15-minute. But as soon as you get a whole candle below all three moving averages, then you know that this one is ready. This one is ripe for the plucking, as they say. Okay. So you'll be able to put this on a short list of this is ready. Now we're looking for the next step. Okay. This, of course, is what a whole candle below. And when I say a whole candle, I mean the open, the close, the high, the low, everything is below the moving average. Okay. This is an example of a potential long. This is the US CAD, USD CAD, Canadian dollar. Um, Again, these are old charts, and these were just chosen to have good examples of all these things that we're looking for. Okay. So this is a whole candle. Actually, it looks to me like this is also, let me get my little pen out here. This looks like it's also completely above. So it's possible that this candle right here would have met the criteria. But the point is, you want the whole candle above all three moving averages. Okay. Now, after you get the candle completely below or completely above, as the case may be, you're going to wait for a pullback candle. Okay. So I'm having trouble manipulating uh, my little drawing tool here this morning. I'm not sure what's going on. Anyway, here's an example of this candle is completely above the moving averages. Now we wait until we get a pullback candle. So this candle is above. We're looking for a long. This candle is green. This candle is green. This one is red. So that's your pullback candle. Okay. Can't draw either. Okay. After the pullback candle, the red candle, you're looking for the very next green candle. Now, in this case, it happens to be the next candle. Okay. But what if this made another candle down here? Whoops. And then another candle down here, and another candle down here, and got back into the moving averages. Well, that kind of negates the whole trade, but I'll talk about that some more. In this case, though, you're looking for the first green candle, and on the close of the first green candle, you buy. It's as simple as that. So, just to review those steps, you have determined that you're going to be going long on this. This happens to be the pound dollar. This happens to be 60-minute chart. So let's say you looked at the 4-hour chart and the time frame. The trend is long because on the 4-hour chart, price was above all the moving averages. Now you're down on the 60-minute chart looking for signals. This is your first indication that you've got a signal, and that is a complete candle above the moving averages. Then you're going to look for a pullback candle. So the pullback candle in this case will be the first red candle you see. And of course, a red candle means that the close was below the open. Then after you find your first pullback candle, you wait for your first green candle or bullish candle after that. And then you enter on the close. So you really only have to look at these once an hour if you're looking at hourly charts. Go through your candles once an hour to find your opportunities. Okay, and of course, every time you look and you have one of these signals, that narrows down the number of charts you have to look for your actual trade signal. So, in other words, if you start by looking at 28 charts and then you only have, uh, say, 12 of them in a longer term trend and all the rest of them are in the spaghetti or just going sideways, that narrows down the number of charts that you have to look at for the next several hours. and so on. Okay. Once you're in this trade, well, here's an example of a situation that I was talking about earlier. This is the first candle completely above the moving averages. This is the first pullback candle right here. Now, at this point, you are waiting for a green candle. Well, we got red, we got red, we got red, we got red, and it's back into the moving averages again. So this is done. You got the first two signals here, but the third signal fell flat. So you're out of this one. This is a no trade right here. Okay. So that keeps you out of situations where price kind of head fakes and goes back into the moving averages. Okay. Okay, so once you actually enter this trade, your stop loss is going to be on the opposite side of the moving averages, down here somewhere. And how far depends on the time frame that you're trading. Okay, if you're trading 5-minute charts, you probably want to use a 5 or 10 pip stop. But on daily charts, you probably have to use more like a 30 to 50 pip stop. But whatever gets you a few pips below the moving averages. Okay. Um, Manage your risk. You probably need to calculate, no, probably about it. You need to calculate your risk as soon as you know how big your stop loss is going to be. And that's what you'll want to use a Forex trade size calculator for. Um, Trading Strategy Guides has got a nice one. I'll put the link to it below so that you guys can use it. But basically, you tell it what pair you're trading, tell it how much in dollars you're willing to risk, and it will calculate and tell it how big the stop loss is, and it will calculate what trade size to use to maintain that risk. Okay. So I personally use a 2% risk number. Um, so no one trade, I will not risk more than 2% of my account on any one trade. Sometimes less than that. And if you follow my videos, you'll hear me talk about that, half size trades and that sort of thing. But my risk is 2% maximum on my trading account. Okay. And then, of course, you take profit as soon as the price touches the 80 again. So price is above the moving averages. You enter your trade, you follow it. Price did not touch the lowest or the 80 period moving average in this case. It didn't touch it here. It continued on up, finally hit it right here. So as soon as price touches that 80, close your trade. That suggests that price is reversing at that point, which in this case it pretty much did. Okay. Now, you also know that I like to target the one average true range uh, for my first target and then take half the trade off and then let it run and follow stops or whatever. But this is a really good strategy for exiting the second half. I almost always, I shouldn't say almost always, I pretty much, unless I'm using a different strategy, I pretty much always take half the profit at one ATR and use 1.5 ATR for my stop loss, like I was talking about when we were talking about the crude oil trade. So I move my stop to break even on the second half after I get profit on the first half, and then I let it run. So you still have to have a good exit strategy, and I follow stops in some cases. Some of the trades I do, I actually have an exit indicator that when the indicator reverses, I say, okay, it's time to get out. I use Heikin-Ashi candles for that a lot of times. The default settings, pretty much. But this is an excellent indicator to, or excellent, I'm getting tongue tied this morning. Excellent exit strategy on this pullback to the 80 period moving average. Okay. So that's the big three trading strategy. I'll put a link to the blog entry, but I want to warn you that I changed the steps. I think the writer was just working hard to get a 3-step strategy to justify the name, but I think he left out crucial steps. So I changed them. The strategy is exactly the same. I just called the steps different things. So one thing I want to recommend is figure out what time frame you want to trade on this and stick to it. The images are from a whole bunch of different time frames because the writer was looking for examples, good examples to show you. But you'll want to stick to one time frame. Like I say, I have trouble trading on the short-term charts because I can't stare at charts all day. I miss entries on short-term or short time frame charts. But I might be able to handle the 4-hour, but the 4-hour requires you to look at charts all the time, the middle of the night, and so on and so forth. So I'm better focused on the daily charts. But if you have razor focus, you might be able to scalp on the tick charts. I've tried that. That's just too intense for me. What can I say? You have fun with that. Always remember to check the predominant trend on the next higher time frame and only trade in that direction. That way, you'll get big runs like this if you're following the higher time frame. Otherwise, you could just easily get a bunch of head fakes. So now, here is the big deal. Be sure you backtest and forward test everything before using it. Why? Because you need to have confidence in your strategies so you'll stick with them, even when they're going through a drawdown period. And they do go through drawdown periods all the time. Okay? So make sure that you do a lot of testing, back testing, forward testing, everything. Okay? Confidence in your strategy is the most important thing. Okay. Let me cover this one question first out of order. Veli Pekka, I hope I pronounced that right. Does it matter if you use EMA or SMA? I think probably not. EMA reacts a lot more quickly, but it may get you into trades earlier that end up being head fakes. My word is just like I just said, back test. Find the thing that's best for you. Okay. Tony, how you doing, man? Post charts, past charts are being used to show us do not trade until you do your own back testing. Yes. Even then right. Absolutely. Awesome. And you actually typed that before I said that. So that's very cool. That is very cool. So yes, test. Make sure that you are good with this. Try the 20, 40, and 80. Rex, you asked, let's see. These are simple moving average, but try them all. 20, 40, 80. Deborah, the calculator is free. I'll put a link below the video. So check the video, and it's very nice, very quick, very easy. Okay. Let's see, Rex, I missed the beginning of the webinar. I may know what to look for on the high. You're just looking for the general trend on the higher time frame charts. So in other words, is price above all the moving averages or below all the moving averages or just right smack in the middle? This, let me go back to those slides. This is an example of an uptrend on the longer time frame. You'll want to look for that or price below the moving averages. If it looks like this, then just stay away from it. Just skip that one for the day. Okay. This video will be posted as soon as it's done. I think it gets posted automatically right away. So you can go back and look over this stuff again if you need to. Let me go back and see if I missed any other questions. Let's see. Moving average values 20, 40, and 80, like Rex said. Simple moving average, like Tony said. I appreciate you guys staying ahead of me. Okay. You're welcome. You guys are awesome. Okay. Let me. Any questions? Any other questions? Any kind of trading questions? Bola, I would suggest testing, doing a lot of testing. I don't recommend that any of you just take this strategy and start trading it tomorrow morning with real money. You need to back test, forward test, and I know that's the tedious part of being a trader. That's annoying, and that's the time-consuming part of being a trader. But once you do it and you have a strategy that you have confidence in, you pretty much don't have to do that anymore, you know? Now, I mean, you want to have several strategies in your toolbox that, so you're going to have to do this testing on several strategies. But once you've done it, you've got it. You got it for the rest of your life. So spend some weeks, spend some big time hours going through charts and looking at them. And the more you look at charts and the more you get used to how price moves, the better you are at seeing things, finding things, noticing things that are not right, noticing things that make you uncomfortable, and so on. So, as you can imagine, I have countless hours of looking at charts, and I started in 2004. So I think there's going to be probably a little biopic of my trading journey coming out at Trading Strategy Guides in the next few weeks. So the synopsis is I started in 2004, but didn't really understand anything until 2009. And that's because I've always been the guy who could learn things from reading, and I didn't get mentors, and I didn't, and I was arrogant. What can I say? Well, they say an arrogant intellectual. When I finally hooked up with Casey Stubbs and started learning from him and some other people that were associated with him at the time, I started to begin to understand some things. So that's when things started moving forward for me. So Ed, strategy for finding candidates. No, I would just start with the 28 currency pairs at the beginning of my trading day and just look through all of them and find the ones on the higher time frame that that are not in the weeds, so to speak, not in the spaghetti, that are not going sideways, and then I would go from there. So, Kathy, correlation is a good thing and a bad thing. I've studied correlation, and like, for instance, the Aussie US dollar and the New Zealand US dollar tend to move in the same direction. If you compare their charts side by side, you'll see they sort of do that. Unfortunately, I haven't been able to get a really serious edge from that correlation. And there are other pairs like the Swissy and the Euro, like have a tendency to move together. And you can tell that because the Euro Swissy hardly moves at all. But again, it does, and sometimes they correlate and sometimes they don't. So you have to study the correlation on the pairs for sure. Matthew, forward testing is simply testing it on live prices, on a demo account or a tiny account. I've always been a proponent, particularly in Forex, of trading real money, but trade a tiny account. You can go to Oanda, OANDA, who is a broker, and they will allow you to trade tiny size, one unit of currency. A micro lot, which is the smallest you can trade on any MetaTrader platform, is 1,000 units of currency. But Oanda on their native platform, FX Trade or whatever, will allow you to trade single units of currency. Or Oanda, if you have an Oanda account, you can attach it to TradingView and trade single units of currency, which means your risk is like 1/100 of a cent or something per pip. So, but it's trading real money, and it just feels more real to me than trading on a demo account. But forward testing is simply trading it just like you would be trading it in real, real money. I deserve an episode on billions. Yeah. If I had billions, then that probably might be appropriate. DK, I have not used this particular strategy in a very long time. So I recommend that you try it out. Basically, what I do on these webinars is I take a strategy that Trading Strategy Guides has done a blog entry about, and I learn the strategy and teach the strategy, okay, to give you guys options and things to try and put in your toolbox. That's also the reason why I say test, test, test. These strategies have been tested at some point in the past, but I personally have not traded. I have used a strategy just like this quite a while ago, long time ago. But it was during my try strategies until they lose phase, which is definitely not the right thing to do. Don't do as I do as I say, okay? A lot of people take a strategy and they'll trade it and they'll trade it and they'll trade it, and then it'll lose and they'll say, nope, I'm done with that strategy. No, that's no way to get ahead in trading, okay? That's the reason why I say backtest your strategy and stick with it when you get into a drawdown, because if your strategy worked in your back testing, then it's gonna keep working. Okay. So let's see. Roy, yes, 20, 40, and 80 simple moving average. Rex, I think that currency strength meter is a really cool thing. But like every other indicator, that's telling you what is true right now, right this second, which may or may not be what's true 5 seconds from now. Okay. So just like any other indicator, figure out a strategy that works with it and use that strategy. I think the currency strength meter is a great tool, but there is no holy grail. And if there is a holy grail, it's trade management. It's not any particular entry indicator. Because with proper trade management, you can trade in almost any direction randomly and still be profitable. I don't recommend trying that, though. I have actually tried that. Yeah, I've tried a lot of things over the years. Let's see. Tony, absolutely right. Try them all. 10, 20, 40, 25, 50, 100, all of them. If you like Fibonacci numbers, then, 21, 35, and I don't know, some other high Fibonacci number. So, no, Nina, I would say try this on everything. Back test it. Test, test, test. Stocks, currencies, cryptos, futures, everything. Oh, Ricky, I so am with you on that. That whole testing thing, I learned that from hard experience, okay? Because not only do you want to test your strategy, but the testing is not only, so many times I'd say, well, this person presented this strategy, so it must be a great strategy. And maybe it was a great strategy for him. Maybe it worked great for him. But when I started using it, it lost the first time I used it, so I gave up on it. That's that is definitely not the right way to be, you guys. Take a strategy, even if it's a good proven strategy from someone you trust, take that strategy and test it because you personally need to have confidence that this strategy works in the thick and the thin. And one loss is what I call anecdotal evidence. I lost one time because news whipped around and took me out. So I'm never going to trade news again. You know, wrong, wrong attitude. That's so much of trading is psychology, and that's why you back test because you need to know that this strategy works and has worked and will continue to work. So that you'll keep going and you won't be moving on to something else after you know one loss or two losses or something. So yeah, I've lost a lot because I did not get the proper guidance. So I blew out some pretty good sized trading accounts before I learned how to not lose. And not losing is the first step to being a successful trader. Learning how to manage your risk, and not losing is about managing your risk. I blew out accounts because I was trading huge risk. I was doing, um, uh, doubling down and all kinds of other crazy strategies that risk huge amounts for small gains. And that was just, I mean, Um, they're great until they aren't great. And when they're not great, they blow your account out. So I made, just as an example, at one point, I had made 700%. I took like a $200 account and traded it up to, I don't know, 2,000, 2,100 in 2 weeks, 2 weeks time, which was pretty good, and it was increasing at an exponential rate. But then that trend that I was riding turned. It didn't really turn. The trend continued, but it pulled back way, 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 way further than I was able to hold on. It blew out my account. So I went from 200 or 250 or something up to $2,100 in the space of 2 weeks. And then inside the space of a few minutes, I was down to $400. Now, I was so devastated that I didn't look at the fact that I had doubled my money in 2 weeks. All I looked at the fact was I had 2,100 and now I have $400. So that was devastating to me. I quit trading for a couple of weeks anyway. I'm not a quitter. But I had to get past that, the emotional part of that one. But what I learned from that was managing my risk. The movement, a sudden movement on the part of one currency should never blow my account out like that. Okay. So, uh, let's see. DK. Yes. Yeah. I'm so done with anything other than daily charts. once in a while, I'll take a strategy that I particularly like on the daily, and I'll try it out on an hourly chart just to see if it'll work. But Rex, you're welcome. You're welcome. Mark, I just draw support and resistance zones on the weekly and look for swing trades. Yeah, that's great. If that works good for you, that's awesome. And I'm not saying that condescendingly. I mean really. I'm a firm believer in you doing you, because trading is a hugely personal thing. One of the guys I was following early on could trade 2-minute charts 18 hours a day. And I tried to do that with him, and I just lost money. And he'd make huge amounts of money every day. And so that's when I figured out how close this is related to your own psychology, your own personal psychology. So, yeah, Mark. Yeah, I used to be a rock climber and whitewater kayaker, and the truth is, I probably will do those things again when I'm back in shape, but I will probably risk a whole lot less than I did when I was 25 and doing those things. So, Chris, yes, I would try this on crypto. Everybody is looking at what Bitcoin did, and it went from zero or 50 cents up to $20,000 and made instant gazillionaires out of everybody. And now they're everybody wants to buy cryptos, buy Bitcoins, so they'll go to 100,000. And no, I'm not doing that either. I have a few cryptocurrencies in a wallet. Just it's just a good store of value. The U.S. dollar is not always a good store of value. Um, Gold is a good store of value, but in certain situations, if I own gold on paper, that's not going to be helpful to me if the U.S. dollar crashes. If I have physical gold in my possession, then maybe. But how do you actually use that? But cryptocurrencies, on the other hand, and more places are accepting Bitcoin as payment for things. So, so yeah, I do hold some Bitcoins and some Litecoins and stuff. But when it comes to actually trading cryptos, I trade them just like everything else. I look at the chart, I look for consolidations, I trade a breakout from that consolidation, and I take my profit when I've got profit, and I close it when it starts fizzling. The move starts to fizzle. So yeah, I would definitely try this strategy on cryptos. Cryptos rise when the Dow falls. You know what, Kathy? I haven't really looked at um, that. I haven't compared those charts yet, and that's a nice thing about TradingView. You can lay one chart on top of another and look at them side by side. But it would not surprise me if there was a correlation between those and gold, and and even some of the other safe haven currencies like uh, Swissies and yens and that sort of thing. But here's the thing: fiat currencies are not really safe havens. They're all made up of air. So, and they're all manipulated by the governments who maintain them. So, cryptocurrencies are less likely to be manipulated by anyone. So, so there you go. I think that's probably the latest. I mean, I guess they're made up of air too. So, I guess the only thing that's real is what I've got in my hand. And, and maybe the only thing that's real is food and tools and things that are actually useful, directly useful. So, but I wax philosophical here. Okay, let's take a look at today's trading maxim. Now, you know, a maxim is a general truth, fundamental principle, rule of conduct, or sometimes it's just a proverbial saying. My maxims come from various sources, including reading, internet, suggestions from friends, coaches, teachers, and sometimes from you guys right in your comments. Purpose to the maxims is to motivate me to discipline. I recommend that you start your own list of maxims, things that you can say to yourself while you're trading to make sure that you always do the right thing, because that's the important thing in trading is discipline. Feel free to borrow from my list anytime you want. And today I'm reaching way, way deep in my bag of tricks. Trading maxim number 11. Don't practice until you get it right. Practice until you can't get it wrong. Uh, you know, I like to attribute my maxims to the original writer, but I have no clue who wrote this. Because when I say I'm digging deep, I really mean this. One of my music teachers, when I was a kid, told me this one. So, you know, 3 or 4 years ago. And if you believe that one, I've got land. Never mind. Anyway, my dad was one of my music teachers. So it may have been him or one of the others. I'm pretty sure if it was my dad, I would have remembered that it was him. But I was probably 9 or 10 years old at the time. So you can imagine how long ago that was. But I think it's pretty self-explanatory. Um, I think it applies really well to trading. You have got to have an intimate knowledge of your trading platform, the markets you're trading, your charts, your indicators, your strategies, everything. Plus, you have to have confidence in them. So this is the back testing. This is the forward testing. This is the practice until you can't get it wrong. It's going to help you to notice when something isn't right. So lots of practice and lots of testing. So it's intended to give you the intimacy you need in your strategy and in your platform and in everything in the market itself, that helps for you to be successful. You don't have to know everything about every market in the world. I thought I did. I used to read. I read a lot anyway and always have, at least since school, middle school. But I used to read everything, and because I thought the more I knew about the markets, the better trader I would be. But really, it doesn't come down to that. It comes down to knowing your strategy and knowing what's part of your strategy. So, so practice, 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 as I'm sure many of my music teachers used to tell me. So, let's see. You want to know more about my system? If you follow my um, analysis videos on Monday and Friday, I just about explain my system every week in those videos, and it's mainly because I have a bunch of new subscribers all the time. So I just repeat it so that everybody gets it. And I kind of went over that earlier in the crude oil. And the only part that probably is not in my videos is how I find my uh, markets to trade in to start with. And basically, I do that by looking at two emails that I get, one called the Morning Brew and one called, um, of course, I would just totally draw a blank at this moment. Um, Morning Brew and The Hustle. I also look at one of Casey's websites, Casey Stubbs, who owns Trading Strategy Guides, has a website called financeandmarkets.com. And I look there. The links to all these things will be below this video. So you can find links to these emails. And basically, I don't look at them for the news, although I've always been interested in news. But I don't look at them for the news so much as to find things to trade. So any business, any stock, any currency, anything that's mentioned in the news, I look at the chart to see what's going on with it. And some of them the charts I keep, and I'll give you a brief on how I track them. I have this big watch list right here, and that's actually my currency watch list. I have this big watch list right here that has all these things in it, and I look at these particular markets regularly. Okay. And I could probably post a list of these, my current list of markets that I look at. The ones that are red tagged are the ones that actually have that either I'm actually trading or actually have patterns on them right now that I'm watching for a break. So Aetherium has got well, and sometimes TradingView loses my setups, but basically Aetherium has this continuation triangle on it right here with a reduction in volume and this decline in volatility. And that's what I look for. I look for the pattern with the reduction in or the decline in volume and volatility. And this is what I look for. Now I'm going to look for a close outside of this triangle on this. So anyway, these are all things that I'm looking for a break on. Somebody mentioned EURCAD. Oh yeah, EURCAD is breaking nicely. Don't have anywhere near enough volume on it yet though. So, but you know, the market is just opening. So, I mean, it's still morning, in other words. So there's lots of time for that to happen. But this is one I'm watching, and if this closes down here with sufficient volume, I will take it short. So I won't have to look at this until the end of the trading day, which is 4 o'clock my time, 5 o'clock New York time. Urban Outfitters, I mentioned this in a video a week or so ago. Looking for a break outside this range, and so on. And then I have the green ones, which I think are going to show a pattern shortly. But those are the ones that I'm looking for action on. But after I look at those, then I look at my main watch list, and then I look for new ones to take a look at. Okay. So that's, in a nutshell, that's kind of how I do it. But then basically it's about looking for the consolidation patterns, mostly triangle patterns and trading ranges. And then looking for this right here, a reduction in volume and volatility kind of confirms the pattern for me. Now, this gold right here had a reduction in volume, but not really in volatility. So this one kind of, and it fizzled. It did hit my first target, but it dropped right back down into this consolidation. So that is a 20 period moving average on my volume, which I think is the default for TradingView volume. And the ATR is a 14 period ATR. Let's see. Chris, yes, if I see something on crypto, I'll put it in one of my videos. I do analysis videos on Monday and Friday right here on this channel. So subscribe and hit the bell, and it'll give you the notification when my video comes out. I sometimes will mention that I'm entering a trade, but mostly if I say that I'm going to enter a trade on a video, I'll enter it when it actually triggers. So I don't always mention that. I usually mention it in the next video just to give everybody updates on our currently open trades. Also follow me on Twitter because if something changes between videos, and I mean if I change a line if I move something or something that you can't have known from watching my prior videos. I'll mention it on Twitter. Sometimes I'll mention my actual entries on Twitter, sometimes not. So, and also follow trading strategy guides at TradingView, and also me on TradingView. Is it coffee yet? Which is my Twitter handle as well, because I do post charts on TradingView sometimes too, and trading strategy guides post charts on TradingView all the time. I mean, like multiple charts a day. Those guys are like animals when it comes to posting trading ideas on. Some of the trading ideas come from my videos, but most of them don't. So, Kuldeep, forgive me if I don't pronounce that right. I don't trade binaries, and it's mainly because I haven't found a system that works well for binaries yet. And the reason is because there is so much um, cost to trading binaries. In other words, you've got to, um, I don't remember the problem, but I had a strategy that I thought would work great, and it would have if I was actually trading 1-to-1, but I wasn't, because of the commission cost or spread or whatever it was on binaries. I don't know that much about binary options, but I would love to find a great binary options strategy. Um, but I use this on stocks, Forex, cryptos, commodities, futures, index futures. I don't trade meats or agricultural futures yet. Um, they seem to be more seasonal, but I may start looking at those. I have a friend who trades spreads in agricultural products, um, but I like to look at the metals and crude oil and all those things too, and the indexes like the Dow and the S&P and the Russell and those NASDAQ. So, and this strategy with the consolidation and the volume, I like it a lot because I'll trade anything that shows volume, that has volume showing right here, which is the reason why I don't try to use the dollar index so much, because I use that volume to confirm the patterns, and I also use that volume to confirm my entries. So if it doesn't show volume, that kind of hamstrings my whole strategy. So I don't trade like SPX because it doesn't show volume, at least not here on TradingView. But I do trade the ES1, which is the S&P 500 E-mini, S&P 500 futures. And you see I've got yeah, this is really attacking this top line here. This looks like it's about to break higher. So I will definitely consider looking at this more closely. Any other questions, comments, opposing viewpoints? I am definitely not afraid of opposing viewpoints, guys. So if you disagree with me or you think I'm ugly and my mom addresses me funny, except you probably don't know that because I don't have the camera on. But there is a reason why the camera's not on. Oh, in any case, any other questions? Okay, remember the strategy, the big three trading strategy. First, determine your current trend direction on a higher time frame. And you do that by seeing which side of the moving averages the price is on. Next step, wait for an entire candle to close outside of the moving averages in the proper direction that coincides with your higher time frame. Then when you get the candle completely above or below the moving averages, you wait for a pullback candle in the opposite direction. Then you enter the trade on the close of the first candle that resumes that trend. Put your stop on the opposite side of the moving average and take profit when price touches the 80 SMA again, or whatever your longest SMA is, or MA. I'm saying MA. If you like EMA or one of the other ones better, go for it. Just test it a lot. Cool. Any other questions? So this is cool. If you don't have time to analyze charts, or maybe you just don't want to, you can get these Strike Trader Elite trade signals from Trading Strategy Guides. They're Forex trade signals on a dozen or so pairs on several different time frames, and they're all based on the Strike Trader Elite system. I'll put a link below to the free signals on the Telegraph application, and I'll also post a link that explains the Strike Trader Elite system. Hey, let's do this again next week. Hey. Come back on Wednesdays at 9 a.m. U.S. Eastern Time, New York time, for these webinars. And watch for my analysis videos on Monday and Friday. My analysis videos are a whole lot more professional because I can cut out the ums and the ahs. Rex, I'll put that link in the video below. It probably take me 30 or 40 minutes, 45 minutes to do it. Okay. Thanks for watching, you guys, and thanks for subscribing. And if this helped you, please hit the thumbs up below. You're welcome, Kathy, Nina. You guys have a great remainder to your week. You're welcome, Rex. I will see you next time.